When you apply for an insurance policy, your insurer will ask some questions about you and your business. It's important to answer all the questions correctly, as well as to the best of your knowledge. It's called your duty of disclosure. If you fail to fulfill this duty, your insurer could refuse to pay a claim and cancel your policy. It's also important to understand all of the terms and conditions such as any limits, exclusions, excess, and the claims basis of the policy. This will help you get an idea of what's included and what's not, so that you don't get a nasty surprise when it's time to make a claim. But don't worry, because everything you need to know will be outlined in the PDS, or Product Disclosure Statement. And if there's something you don't understand, you can always ask. Firstly, we'll start with the policy excess. Just like your car insurance, business insurance has an excess, which is the amount of money you'll need to pay when you make a claim under the policy. For example, public liability policies usually have an excess of $500, meaning you'll have to pay the first $500 worth of losses, and your insurer will pay the rest of the claim, providing it doesn't exceed the policy limit. Now let's go over some of the important basics like occurrence-based policies, claims-made policies, and runoff cover. An occurrence-based policy means it will pay out on claims made where the loss or damage occurred during the period of insurance, regardless of when the claim is reported. That means it will respond to claims that come in even after the policy has ended or been cancelled, so long as the incident occurred during the time the policy was active. So basically, it offers permanent protection for incidents that occurred during the policy period. Most public liability policies are occurrence-based policies. Now let's look at claims-made policies. Claims-made policies mean you need to have an active policy to be able to make a claim regardless of when the incident actually happened. So once the policy had ended or been cancelled, you can't make a claim against it, even if the incident happened before the policy ended. Professional indemnity insurance is usually a claims-made policy. You've also got the option to include something called runoff cover with a claims-made policy. It provides protection for any claims made against you when you stop operating your business and you no longer need a professional indemnity policy, like when you retire, or if you just simply decide to close your business for whatever reason. It's important for professionals because things can still go wrong, even months or years down the track. And if somebody tries to sue you, you won't be covered under an old professional indemnity policy.